In that unending, sometimes deafening, and often frightening chaos of the financial markets, the biggest trap that millions of traders waiting in front of their screens fall into every day is believing that prices move in a completely chaotic and random way. Yet, no matter how irregular and fierce the markets may appear on the surface, they are actually part of a specific rhythm, a massive order deep down that has not yet been fully discovered. Today in this podcast episode, we are going to examine in depth the technical analysis perspective, the technical anatomy of his systems, and the sharp philosophy that sets him apart. The legendary figure Larry Williams, who turned $10,000 into $1.1 million in just 12 months by putting theory into practice. Contrary to popular belief, technical analysis for Larry Williams is not the art of predicting the future. In his world, charts are not a crystal ball whispering what will happen tomorrow. They are a cold-blooded, mathematical measurement tool used to measure probabilities in the market, detect current imbalances, and capture a statistical advantage. He emphasizes at every opportunity that the market is unpredictable with absolute accuracy, but he argues that the traces left by human behavior are measurable within certain mathematical and temporal patterns. Therefore, on Larry Williams's desk, there is no room for rote memorization of patterns, chasing only indicator signals, or emotional expectations such as, "It will definitely reverse from here." For him, technical analysis consists solely of reading that mysterious preparation phase of the market. At the heart of this approach lies the technical analysis of the behavior exhibited by the price, rather than the price itself. The logic Williams built, especially on accumulation and distribution, is the first and greatest revolution that broke him away from classical technical analysis. Most people see these concepts as simple buying or selling pressure. However, Williams focuses on what the price does not do. For example, if the price is not rising in a market but is also not falling sharply, if there seems to be a great deal of selling pressure but the price fails to make progress, Williams doesn't just see a bear market there. He asks this critical technical question: if there is really this much selling, why can't the price go down? This question leads him to the fact that price is only a result, while the inability of the price to move is the actual information. For Williams, price movement is a result. The real thing to look for is the traces of that invisible professional hand that prevents or supports that movement. Tools he developed, such as the Williams variable accumulation distribution, are designed to measure this tense relationship between volume and price. These tools tell us whether the smart money is quietly buying while the crowds are selling in panic, or whether professionals are offloading their holdings while everyone else is buying with euphoria. Perhaps the most revolutionary idea Larry Williams brought to the world of technical analysis is that time is far more important than price. While most traders waste their lives in front of screens searching for the answer to the question, "Where will the price go?" Williams pursues the question, "When should this move have happened, and why didn't it?" This perspective directed him towards cycles, intraday time windows, characteristic features of specific days of the week, and month-end, month-beginning effects. In his system, a technical indicator means almost nothing when used without a time filter. The only way to clean up that intense price noise in short-term markets is to place the analysis on the time axis. Price is variable and can be manipulated. However, time is the harshest and most unchangeable constraint of the market. Williams particularly emphasizes seasonal cycles. From commodity markets to stock indices, he has proven with statistical data how money changes direction at certain times of the year. For example, data such as which months of the year the gold market tends to rise or which days of the month the S&P 500 index diverges positively form the backbone of his technical analysis. He knows the market has a calendar, and he describes price movements that do not fit this calendar as an anomaly, stating that the real opportunity lies in these deviations. His stance regarding indicators is completely outside the realm of general teachings. The Williams %R indicator, which bears his name and is found as a standard on every platform today, is the clearest example of this. In a standard education, %R falling below -80 is taught as oversold, meaning buy, or rising above -20 as overbought, meaning sell. For Larry Williams, this approach is a technical error. He sees the indicator not as a signal machine, but as a location gauge. %R measures the distance of the price to its high and low within a determined period. Overbought or oversold zones are not a guarantee of a reversal, but rather preparation areas that show the strength or weakness of the market. The indicator doesn't tell you buy now. It says the market is currently in this region and structurally at this stage. Therefore, he always uses indicators in combination with market structure, time cycles, and the current momentum of the price. For him, the real signal is not an indicator reaching a certain level, but the reaction of the price when it is at that level. If a market has dropped into the oversold zone and stuck there, for Williams, this is not a weakness, but proof of how strong the trend is. Another concept that carried Larry Williams to the top of technical analysis philosophy is the volatility breakout. Williams very well analyzed that spiral structure where markets pass from low volatility to high volatility, and from high volatility back to low volatility. Most traders try to enter a trade when the market is already moving. Williams, on the other hand, waits for moments when the market squeezes and volatility drops like the tensioning of a spring. According to him, big moves are born from the quietest moments. Crossing the price range of the previous day or a certain period by a certain coefficient is one of the most reliable entry signals for him. This is proof that the market has made a decision about its direction. At this point, technical definitions such as smash day or hidden smash day explain how market participants are lured into traps and how professionals benefit from these traps. For example, the price closing below the previous day's low and then quickly rising above that level the next day is a technical bear trap for Williams, and it is considered one of the strongest bullish signals. The core idea in these strategies is to identify that moment when the market collects assets from the hands of the weakest-looking participants and to get on the same boat as the professionals. Larry Williams' technical analysis approach doesn't stop at just reading charts. It also involves watching the big players behind the scenes. Blending COT, commitment of traders, reports with technical analysis makes him unique as a speculator. He compares the positions of large commercial players in the futures markets with the positions of small investors. If the big players have moved into a massive buying position in a product but the price is still moving sideways, Williams prepares for a technical explosion. According to him, the candles we see on the chart are just the tip of the iceberg. The real movement begins with the accumulation of capital behind those candles. Technical analysis is like a stopwatch that helps us understand when this capital accumulation will go into action. At this point, a very critical distinction must be made. In the Williams philosophy, technical analysis is used as an elimination mechanism to not enter a trade, rather than to enter one. The secret of professional trading is not trying to catch every wave, but being able to eliminate times when the statistical advantage is not on your side. Williams' systems free the trader from the feeling of having to be in the market, that is, from the disease of overtrading. According to him, every signal is not a trade, and your greatest power in the market is your freedom not to trade. So, what is the actual secret that has made Larry Williams so successful for decades and keeps his systems relevant even in the age of algorithms? First, he never predicts. He always measures. He never makes ambitious and ego-driven statements like, "The price will definitely go there." Instead, he talks about probabilities, standard deviations, and statistics. Second, he accepts losing as a natural and inevitable part of the job. Larry Williams never hesitates to talk about his own big losses and the moments he returned from the brink of bankruptcy. This honesty has allowed him to place the mathematics of money management and position sizing at the heart of his systems. According to Williams, even if you have the best technical analysis method in the world, you will eventually be out of the game if you are not managing your risk correctly in every trade. Even in his famous $1.1 million record, the real hero was not the technical indicators he used, but probability-based position sizing management like the Kelly criterion. He has proven time and again that it is not about how right you are, but how much you earn when you are right and how little you lose when you are wrong. Another great strength of Williams is knowing that the market actually consists of people, and that human nature will never change. Today, artificial intelligence, high-frequency bots, and complex algorithms may dominate the market. However, both those who program these machines and the audience these machines target ultimately carry the traces of human psychology. Fear, greed, impatience, and hope. These were the same 100 years ago, and they are the same today. Williams' systems are built on these unchanging human reactions. Those sharp sell candles that form when people panic, or the buys made at peak points with euphoria, immediately manifest themselves as a location in Williams' indicators. He trades not with machines, but with the human mentality behind those machines. When you combine technical analysis in a triangle of context, time, and structure, you actually get a pulse meter that measures the collective psychology of those trading in the market. His successes are not the result of a single mathematical formula. These successes are the result of deep respect for market reality and unshakable discipline. From commodity markets to stocks, he has defended the same basic principle everywhere. Market behavior repeats because human nature repeats. However, selectivity is essential to catch this repetition. The real secret of short-term trading is not moving fast, but having an unshakable patience to wait for the right moment. Opportunities are always there, but quality opportunities that offer a high statistical chance of success are rare. Larry Williams teaches us this: we should see the market not as an enemy, but as a natural event with rules. We cannot predict the exact second a storm will break, but we can measure that a storm is approaching from the color of the clouds and the speed of the wind. In conclusion, this technical legacy Larry Williams has left us advises against approaching the market with arrogance. The market has no obligation or debt to prove you right. However, you have an obligation to control your capital and your risk. When you stop seeing technical analysis as a tool for fortune-telling and accept it as a behavioral statistics discipline, trading stops being a stressful gamble for you and turns into a professional business. The moment you stop asking the question, "Where will the price go?" you have actually taken your first big step toward becoming a real trader. As Williams said, asking why the market did not go where it was supposed to go takes you away from the thousands of candles on the chart and leads you to the heart of the truth: the trail of money. Larry Williams' technical analysis approach has a depth far beyond classical lines and patterns. Reading behavior instead of price, putting time at the center, using indicators as milestones rather than compasses, and above all, managing to survive. These are the four fundamental pillars that make him a legend. Every game plan built on these four pillars offers you a reliable roadmap no matter what market you are in. To avoid getting lost in today's complex markets, what you need is not more indicators, but more perspective. These timeless principles of Williams offer us that perspective in abundance. Remember, winning in the market is not just about reading charts. It is about being able to meet your own character and the character of the market on the same mathematical plane. In this journey, discipline, statistics, and timing will always be your best friends.